Usually when you build a massive skyscraper, you expect it to, well, just stand still.
Right.
You pour the concrete, bolt the steel together, and it just stands there against the wind.
Yeah, totally stationary.
Right. And I feel like we expect our massive corporate empires to act the same way. Visible, easy to categorize, and basically unmoving once they get to a certain size. But when you look at Yum China, and this is the undisputed corporate titan running KFC, Pizza Hut, and Taco Bell across the entire Chinese landscape, that whole static blueprint is just completely useless.
Oh, completely. It's not a stationary tower at all.
No, it's more like they are trying to perform a full engine swap on an 18-wheeler while bombing down the highway at like 80 miles an hour.
That is a very accurate and slightly terrifying visual.
Yeah.
But yeah, it's a relentless, high-velocity operational puzzle. And the environment around that vehicle is just changing by the minute.
Exactly. So today we are doing a deep dive into Yum China's Q1 2026 earnings conference call. We're relying entirely on the transcript, specifically looking at the insights from CEO Joey Wat and CFO Adrian Ding.
Yeah, and the stakes here are wild. They are dealing with a consumer base that is fiercely guarding its wallet, plus a delivery ecosystem that is basically rewriting restaurant profit margins overnight.
And despite all that, they are somehow still opening roughly 7 new restaurants every single day.
Kevin, a day, yeah.
It's nuts. It's almost impossible to comprehend that pace. So whether you hold this stock in your retail portfolio, or you're a business student, or just someone trying to figure out how a multinational giant adapts to hyperspeed consumer shifts, our mission today is to translate all the Wall Street jargon into plain, actionable insights.
There's a lot of jargon in these calls.
Oh, tons of it. We're going to look at the data, the story behind the numbers, and what management is signaling for the future. And to really grasp what they are pulling off, you have to look at where they started, Back in 1987, opening one single KFC near Tiananmen Square was this massive cultural event.
Right, it was huge news.
Fast forward to 2026, and they are navigating a world where people are ordering fried chicken directly from the digital dashboards of their electric vehicles.
It's a completely different universe. I mean, the baseline expectations for convenience and speed, and especially value, have totally detached from what they were even 5 years ago, let alone back in 1987.
Yeah.
The fast food industry in China right now is this hyper-competitive battleground. You've got fluctuating consumer sentiment, massive cost pressures, and a delivery infrastructure that is honestly as demanding as it is efficient.
So to figure out how Yum China is keeping its crown, we need to look directly at the headline numbers from this first quarter. And I've got to be honest, at first glance, the numbers look like a total mathematical contradiction.
They really do. Let's break that down because the data is fascinating. So total revenue for the quarter grew by 10%, and operating profits increased by 12% in reporting currencies.
Okay.
Now, management did point out this was supported by some positive foreign exchange impacts. But even if you strip away those currency fluctuations, what they call system sales, still grew by a really healthy 4%.
Right, so top line growth is there.
Exactly. And net income landed at $309 million. Technically, that's flat year over year, but, and this is a big but, they flagged a very specific $9 million negative impact from an equity investment they have in Meituan.
Ah, right, Meituan.
Yeah. So if you strip out that paper loss from the Meituan stock, their net income was actually up 4%.
Okay, and then there's the diluted earnings per share, the EPS, which hit 87 cents. So that's up 7% year over year, or like you said, 11% if we ignore that Meituan investment drag.
Right. So top line is growing, bottom line profit is growing, value per share is growing.
Okay, but hold on. This is where I need to push back because the math feels completely broken when you look at the very next metric they dropped.
The same-store sales.
Yes. They reported that same-store sales growth was slightly positive, but effectively rounded to zero. They literally said it was at 100% of the prior year's levels. Flat.
Dead flat.
So if the individual stores that I walk past every single day aren't selling any more chicken or pizza this year than they did last year, how on earth is total revenue surging by 10% and system sales growing by 4%? I mean, those lines on the graph shouldn't be moving in opposite directions, right?
Yeah, it sounds super counterintuitive until you pull apart the mechanics of those two specific metrics. So you have system sales versus same-store sales. Same-store sales, which, Wall Street analysts sometimes call comparable store sales, only measures the revenue generated by restaurants that have been open for at least one full year.
Okay, so it's isolating the old stores.
Exactly. It isolates the performance of the legacy business. It answers the question, is the existing fleet of restaurants gaining or losing traction?
So if I opened a Pizza Hut 3 years ago, the money it generates this quarter compared to the exact same quarter last year, that's my same-store sales metric.
You got it. And management is telling us that the legacy store is basically just holding the line. It's treading water.
Okay, so where is the growth coming from?
System sales. That is the macro metric. That measures the total revenue generated across every single location with the brand's name, including the brand new stores that literally just opened last week.
Ah, okay.
So when CEO Joey Watt reports that system sales are up 4% while same-store sales are flat, she is basically exposing the absolute core of their growth engine right now. The revenue surge isn't coming from squeezing more dollars out of the mature existing footprint. It is entirely driven by this aggressive deployment of brand new stores.
Okay, it's like a city water system.
Oh, I like that. How so?
Well, the water pressure coming out of the old faucets in the old houses hasn't increased at all. But the city's total water consumption is skyrocketing just because they are building thousands of new houses and hooking them up to the grid.
That is a perfect analogy, yes. They are expanding the physical surface area of the business at a speed that forces total revenue upward, and it completely bypasses the stagnation of the legacy stores.
But there is this really crucial nuance hiding inside that flat same-store sales number, right? CFO Adrian Ding pointed out that while same-store sales were flat, same-store transactions actually grew.
Yes. And it wasn't just a blip. They grew for the 13th consecutive quarter.
Wait, okay, let me get this straight. If the total amount of money going into the cash register is flat, but the number of transactions, the number of people buying stuff is going up, that means the average amount spent per order has to be dropping.
That is the exact mathematical reality. They measure this using ticket average, or TA. The stores are undeniably busier. You have more people walking through the doors or placing digital orders than a year ago. But the consumer is actively managing their own budget. They are coming in more frequently, maybe, but they are buying a smaller combo meal or skipping the extra side dish or just trading down to a more value-oriented promotion.
Man, that paints such a vivid picture of the macroeconomic reality for the Chinese consumer right now. The appetite for the brand is absolutely there. I mean, 13 consecutive quarters of transaction growth proves people actively want KFC and Pizza Hut.
Definitely.
But they are guarding their wallets. They're hungry,
right,
but they're highly value conscious. And what's fascinating to me is that Yum China isn't trying to fight this by forcing price hikes just to artificially inflate that same store sales number.
Right. They aren't fighting the tape. They are adapting the entire corporate structure to accommodate a lower ticket average. They're leaning into the macroeconomic wind instead of trying to build a wall against it.
And we see that same kind of proactive financial engineering when we look at the earnings per share metric. Diluted EPS hitting 87 cents, up 11% if we exclude Dominion. For anyone holding this stock, EPS is basically the ultimate scoreboard.
It is. It's what everyone watches.
So let's translate that Wall Street jargon for a second. If a company's total net income is a pie, earnings per share is the size of the slice that gets handed to each outstanding share of stock.
Yeah.
Now, the traditional way to make the slice bigger is just to bake a bigger pie, right? To generate more raw profit. But Yum China's net income only grew by 4%, yet the EPS grew by 11%. How do you get an 11% bigger slice out of a pie that barely grew?
You reduce the total number of slices, you shrink the denominator.
Buybacks.
Exactly. This is the mechanical result of their aggressive share repurchase program. Yum China uses its cash reserves to go into the open market, buy back its own stock, and retire those shares. So by actively eliminating shares from existence, the ones that are left automatically represent a larger percentage of the company's total earnings.
It's just a highly efficient way for management to engineer value for the existing shareholders, even in a quarter where the raw net income growth is, relatively modest.
And we really should touch on that Meituan investment quickly because it does distort the official net income quite a bit.
Yeah, what is the deal with that?
Well, Meituan is an absolute juggernaut in China. It's this massive super app that dominates food delivery, local services, you name it. And Yum China clearly holds an equity position in them.
Right.
But under standard accounting rules, because Meituan is publicly traded, Yum China has to report the paper gains or losses of that stock portfolio every single quarter, regardless of whether they actually sold any shares.
Ah, okay. So it just introduces all this volatility into their official accounting net income that has literally nothing to do with selling fried chicken or pizza.
Exactly. If the broader Chinese tech sector takes a hit, Meituan's stock price drops, and Yum China has to record a paper loss. In this case, it was a $9 million drag on Q1.
Got it. So that's why Adrian Ding and the team emphasize the numbers, excluding the Meituan impact. It just strips out the noise of the stock market.
Yeah, it lets you evaluate the actual operational machinery of the restaurants.
Okay, so to synthesize all these headline numbers, the legacy stores are holding the line on total sales by funneling a higher volume of transactions from consumers who are just spending a little bit less every time.
Right.
The corporate top line is surging because they are unleashing thousands of new stores. And the EPS is climbing because they're using cash to buy back stock.
That's the playbook.
So this aggressive new store growth engine leads us directly into section 2 here. The physical footprint. How exactly do you open 636 restaurants in 3 months?
Well, you definitely don't do it by following the old playbook. The sheer scale of what they achieved in Q1 is wild. 636 net new stores means they are comfortably ahead of schedule to hit their massive full-year target of 1,900 new locations.
1,900 in a year.
Yeah, and at this trajectory, they are locked in to surpass 20,000 total stores across the country by the end of 2026.
Wow.
But, the real story isn't just the total number, it's the structural shift in who is actually paying to build these things.
Right, because historically, Yum China has been heavily biased toward an equity model. They owned and operated the vast majority of their physical footprint. They signed the leases, bought the fryers, hired the managers. But the data from Q1 shows this massive strategic pivot. Franchisees drove a massive 42% of the new KFC and Pizza Hut store openings. Nearly half of the new growth is suddenly coming from franchise partners. Why this sudden shift away from corporate ownership?
It is a masterclass in capital efficiency and risk mitigation. See, when Yum China builds a corporate store, they deploy their own capital expenditure, their CapEx. They tie up their own cash in the concrete, the kitchen equipment, the long-term lease liabilities.
That's heavy upfront investment.
Exactly. But by shifting this expansion phase to a franchise model, they execute a brilliant transfer of CapEx.
So the local franchise writes the check to build the physical box, buys all the ovens, and takes on the localized operational risk.
Yep.
And Yum China just provides the brand, the supply chain access, and the operating manual, and then just collects a royalty percentage off the top of the gross sales.
It allows them to just blanket the country with new locations without draining their own corporate treasury. And this is particularly crucial as they push into what they call lower tier cities or more remote geographic areas.
Makes sense.
I mean, think about it. A local entrepreneur in a tier 5 city understands the local real estate dynamics and the local labor market way better than some corporate executive sitting in an office in Shanghai.
Oh, absolutely. They're leveraging that highly localized expertise while guarding their own capital. But the most fascinating execution of this franchise strategy they talked about was their move onto the national highway system.
Oh yeah, this is so smart.
They announced they've signed franchise agreements with over a dozen provincial and municipal highway operators. They even referred to these state-backed entities by their Chinese acronyms on the call, like Shengjiaotu and Shengjiaotu. They're partnering directly with the authorities that build and manage the toll roads.
It's an incredibly shrewd real estate play. It capitalizes on a massive macro trend. China's domestic highway network is vast and it's expanding rapidly. Domestic car ownership is up, road trip culture is rising.
Yeah.
And those highway service stations, they're essentially captive markets. When you're driving for 6 hours and you pull into a rest stop, you aren't looking for a high-end culinary adventure.
No, you want something safe, fast, and familiar.
Right. And by using the franchise model, Yum China doesn't have to navigate the crazy process of buying land or negotiating complex leases along a state-owned highway.
They just partner with the entities that already own the land and operate the rest stops. The highway operators get this massive blue chip anchor tenant that drives traffic, and Yum China gets instant access to millions of traveling consumers.
And it works. In just over a year, they used this model to add nearly 100 stores to highway locations, and they made it very clear they are aggressively accelerating that pace.
Okay, but this franchise shift is really only one half of the physical footprint equation.
Yeah.
The other half is the actual physical architecture of the stores they're building. They've totally abandoned the one-size-fits-all approach.
Yeah, the era of the massive multi-story KFC is kind of over.
Right. This is where we see what I like to call their modular warfare. They are deploying highly specialized, asset-light physical units tailored to the exact economic realities of a specific neighborhood. Like, look at the Pizza Hut WOW format.
The WOW stores.
They opened over 100 of these WOW stores in Q1 alone, mostly targeting those new, lower-tier cities. How does a WOW store differ from the traditional Pizza Hut we all picture in our heads?
So the WOW format is engineered from the ground up for minimal capex and radically simplified operations. The physical footprint is significantly smaller, which obviously slashes the real estate costs and construction timelines.
Okay.
And the menu is heavily streamlined. They strip away the complex, low-velocity items to focus just on the core, high-demand pizzas and a few signature sides.
So smaller kitchen, less specialized equipment, easier to train the staff.
Exactly, which makes it the ultimate vehicle for that franchise expansion we just talked about. If you're a potential franchisee in a smaller city, a massive traditional Pizza Hut might represent a terrifying amount of upfront capital.
And operational complexity, too.
Right. But a WOW store is approachable, cheaper to build, easier to staff, faster to launch. And the financial metrics prove it works. They doubled the WRW store count year over year to roughly 390 locations.
Wow.
And importantly, Adrian Ding noted that despite the smaller size and lower price points, the profit margins on these new WOW stores are already operating perfectly in line with the main traditional Pizza Hut model.
Litter risk, faster build time, identical profit percentage. It's a no-brainer. But the architectural hack that truly blew my mind is what they were calling the Gemini stores.
Oh, the Gemini model is brilliant. It's probably their most innovative real estate strategy right now.
So this is where they secure a single piece of real estate and they build a Pizza Hut WOW store immediately, side by side, physically attached to a new KFC.
Yep.
And they opened nearly 80 of these Gemini locations in the first quarter alone. The back-end efficiency of this setup is just staggering.
It really is. I mean, from the consumer's perspective, you walk up to a building and you have two distinct doorways. KFC on the left, Pizza Hut on the right.
It captures the family dynamic perfectly. The kids want fried chicken, the parents want pizza, and nobody has to compromise.
Exactly. But behind the walls, the synergies are immense. They share a single commercial real estate lease. They likely share the HVAC systems, the employee break rooms, maybe even cross-train management.
And when the supply chain truck rolls up, it delivers the chicken and the pepperoni to the exact same loading dock.
Right. It maximizes the revenue yield per square foot of real estate while simultaneously driving down the logistical costs of servicing that location. You don't have to find two separate ideal locations and run two delivery rights. You consolidate the effort.
And their real estate innovation isn't just about the buildings, it's about how those buildings interact with vehicles. We mentioned the highway expansion, but their approach to the traditional drive-thru is undergoing this massive evolution.
Yeah, because the traditional drive-thru model is incredibly capital intensive.
Oh, for sure. You need a huge piece of real estate to carve out a dedicated wraparound concrete lane. You need the intercoms, the specialized windows, all that structural stuff. It severely limits where you can even put a store.
But Yum China has engineered a workaround that totally bypasses the need for all that expensive concrete. They are aggressively rolling out what they call car-side pickup.
Right. So for locations that just lack the physical geometry for a drive-through lane, but they have regular parking spots or a pullover area, they just use the app.
Yep. The consumer orders and pays on their smartphone. Using GPS and localized data, the store knows exactly when the customer pulls into the designated area.
The kitchen times the food prep. And a crew member literally just walks the order out the front door and hands it directly through the car window.
It provides the exact same consumer benefit. You don't have to unbuckle your kids or get out of the car in the rain, but it requires zero structural modifications to the building.
And the adoption rate is explosive. Over 7,000 KFC locations now offer either a traditional drive-thru or this new car-side pickup. That's up from just 2,000 locations a year ago.
Think about that. They basically added 5,000 drive-thru capable locations in 12 months without pouring a single yard of concrete.
It's incredible, and the internal data supports it. In Q1, nearly 1/3 of the customers using these drive-thru and car-side services were first-time users of that specific channel, and more than 1,000 individual KFC stores registered repeat purchases from those new customers within the same quarter.
It's a highly sticky convenience model.
And they are pushing the boundaries of vehicle integration even further. They highlighted a partnership with BYD, the colossal electric vehicle manufacturer in China. They're developing technology to enable in-car ordering directly from the vehicle's built-in dashboard touchscreen.
You don't even need to reach for your phone. The restaurant is literally integrated into the car's operating system.
Plus, they are strategically placing fast charging stations near select store locations. You pull your EV into a charging bay, order on the dashboard screen, someone brings the food to your window, and by the time you finish eating, your car is charged.
They are transforming the restaurant from a static destination into a seamless node in the consumer's daily transit routine. It's brilliant.
It is. They're building smaller, cheaper, faster, using franchise money, and turning regular parking lots into digital drive-thrus. But while the physical footprint expands with incredible efficiency, the actual mechanism of getting the food into the hands of the consumer is undergoing a massive, incredibly costly revolution.
The delivery dilemma.
Yes, Section 3. We have to examine this because this is where the profit margins are under severe attack.
Without question, the shift toward delivery was the most critical operational headwind detailed on the entire earnings call. The change in consumer behavior is permanent, and the economics of fulfilling that behavior are, frankly, punishing.
Let's look at the raw data. Last year, delivery accounted for roughly 42% of Yum China's total sales. That is already a massive chunk. But this year, in Q1, that delivery mix skyrocketed to 54%.
More than half of all the food cooked in their kitchens is now placed in a bag and handed to a rider on a scooter.
And that transition fundamentally rewrites the traditional restaurant P&L. The story behind this massive delivery surge is entirely centered on the cost of the human beings driving those scooters.
Right. Rider costs have ballooned. It's become the single most significant headwind the company is fighting.
Joey Watt was remarkably blunt about this. She stated explicitly that rider costs now account for close to 30% of their total cost of labor. Let that sink in.
30%.
Nearly 1/3 of every single dollar they spend on human labor is now dedicated solely to paying people to transport the food the last mile from the store to the living room.
And as a direct result, their cost of labor as a whole rose by 100 basis points year over year, climbing to 26.7% of total sales.
When analysts look at margins, 100 basis points is a huge swing. It's a full 1% erosion of the revenue before you even pay for the food or the rent.
Exactly.
So hold on, I have to stop here, because this looks like a fatal flaw in the business model. If delivery has breached 54% of total sales, and paying the riders is eating up the profit margin, isn't this just a race to the bottom? As delivery grows to 60 or 70%, won't the logistical costs essentially cannibalize the entire profit margin? How do they survive this?
That is the existential question facing every major restaurant chain right now, especially in China where delivery penetration is so deep.
Right.
But the answer lies in how Yum China ruthlessly mitigates that intense labor pressure by extracting savings from other line items. They focus entirely on protecting the operating profit margin, or OP margin.
Which is the revenue remaining after food, labor, and rent, but before taxes and interest.
Exactly. It's the true measure of operational health.
So the rider costs push the labor line up by 100 basis points, actively destroying the OP margin. Where do they find the savings to stop the bleeding?
They find it in the concrete and the dirt. They find it in the real estate.
Really?
Yeah. Adrian Ding pointed out a highly strategic offset. Their occupancy and other costs dropped by exactly 100 basis points year over year, falling to 23.5% of sales.
Wow. So the labor cost goes up by 1% and the rent cost goes down by 1%. It's a perfect mathematical cancellation. But how do you magically lower your rent across thousands of stores? Landlords don't just volunteer to take a pay cut.
No, they don't. But it requires a deep understanding of the current macroeconomic climate in China's commercial real estate sector. The market is facing significant pressure right now. Vacancy rates in commercial plazas and shopping centers are a real concern. In this environment, landlords are absolutely desperate for stable, reliable, blue-chip anchor tenants who are guaranteed to pay their rent on time and drive consistent foot traffic.
Right. If you own a struggling strip mall in a Tier 4 city and Yum China offers to put a brand new Gemini store on your property, you are going to offer them a spectacular lease rate. You need their brand halo way more than they need your specific piece of dirt.
That is exactly the dynamic. Adrian Ding was very transparent about this. He noted that the current commercial real estate environment is, quote, quite favorable to the merchant as of right now.
Wow.
Yum China is aggressively leveraging its massive scale to force landlords into highly favorable long-term lease agreements. And because they are deploying those smaller WAW and Gemini formats, the upfront capital expenditure is lower, which reduces the accounting depreciation costs hitting that occupancy line item.
So if we look at the macro flow of the money here, they are taking the immense savings generated by cheaper rent in smaller buildings and handing that money directly to the gig economy delivery riders.
Yep.
Yum China is essentially facilitating a massive wealth transfer from commercial real estate developers to the scooter fleets.
Economically, that is a very accurate way to frame it. The physical store is subsidizing the digital delivery. And the ultimate proof that this strategy is working lies in the final margin tally. Despite absorbing that massive blow from the rider costs, Yum China's overall OP margin actually expanded by 20 basis points, reaching 13.7%.
They took the hardest punch the delivery economy could throw, neutralized it through real estate negotiations, and still squeezed out slightly more profit per dollar than last year. That is wild.
It's a staggering operational achievement. And management also highlighted a shift in the behavior of the delivery platforms themselves. The massive third-party apps like Meituan and Ayla.me that aggregate the orders.
Joey Wad offered some commentary on that, right?
She did. She noted they are seeing early signs of a shift toward more rational competition among the delivery aggregators. Historically, these platforms engaged in brutal market share wars, heavily subsidizing the cost of delivery. They were basically paying consumers to order food just to starve out rival platforms.
But you can't run a business on infinite subsidies forever. Eventually, Wall Street wants to see a profit.
Precisely. So those Wild West subsidy days are moderating, particularly for small, low-value orders. The platforms are altering their algorithms to prioritize larger orders, higher ticket average or TA orders, where the economics of dispatching a human rider actually make financial sense.
And Joey noted that this push toward higher TA orders perfectly aligns with Yum China's internal strategy. They don't want a rider burning time and margin delivering a single cup of coffee. They want that rider carrying a family-sized bucket of chicken or 3 pizzas, where the delivery fee is absorbed by a much larger gross profit.
Yum China has consistently maintained a highly disciplined approach to platform integration. They carefully balance top-line sales growth with the absolute necessity of margin protection.
Right.
As the platform subsidies dry up, the weaker independent restaurants that relied entirely on those subsidies will struggle. The players with the strongest internal logistics and real estate leverage like Yum China are positioned to dominate the rationalized market.
Okay, so we've dissected the macro machinery. Franchise capital, modular real estate, and offsetting delivery costs with cheaper rent. But all of this engineering is useless if the consumer doesn't actually crave the food. So let's break down the brand-level battle plans in Section 4, starting with the crown jewel, KFC.
KFC is the dominant cash-generating engine for Yum China, and their performance in Q1 showed incredible resilience. System sales were up a robust 5%, and same-store sales eked out a 1% gain.
A 1% gain might sound small, but in this value-conscious environment, marking the 4th consecutive quarter of positive same-store growth is a massive victory for a legacy brand.
Definitely. And their restaurant-level margin remains incredibly healthy at 19.1%. Sustaining nearly a 20% margin while fighting off delivery costs is practically unheard of right now.
Now, the ticket average at KFC did decline by 1%, but Adrian Ding explained that it wasn't just consumers buying less food for dinner. It was strategically driven by a massive expansion into lower-priced, high-frequency day parts.
Right, specifically breakfast and coffee. These smaller ticket items naturally drag down the average, but the sheer volume of new transactions generates massive gross profit.
Let's talk about those smaller orders, because KFC is launching some fascinating side quests. First is K-Coffee. They aren't just selling coffee at the regular register, they are deploying dedicated K-Coffee modules directly side by side with existing KFC locations.
They have these in over 2,600 locations already, and the volume is exploding. Sales more than doubled year over year.
And their internal targets are super aggressive. They want to hit 5,000 K-Coffee locations by the end of 2027. They view coffee as a habit-forming driver of daily foot traffic, integrating the brand into the consumer's morning routine.
But the brand extension that truly caught my attention was K-Pro.
Oh, K-Pro, yes.
They expanded the K-Pro concept to 280 locations, up from roughly 200 just at the close of last year. And they raised their target to hit 600 locations by year-end, projecting it will generate up to 1 billion RMB in sales this year alone.
What exactly is the culinary philosophy behind K-Pro?
K-Pro is management's heavily engineered response to the surging demand for healthier, nutritionally balanced meals among urban Chinese consumers.
Like salads.
Well, sort of, but Joey Watt captured it perfectly by quoting a viral social media review. The review described K-Pro's food as self-discipline, not self-torture. It focuses on Chinese-style light meals.
Okay, I love that.
It provides a healthy option, but it features warm proteins and substantial grains so the consumer actually feels satiated. It avoids the pitfall of the cold, unfulfilling Western-style salad that leaves you hungry an hour later.
Self-discipline, not self-torture, is brilliant marketing psychology. And from a real estate perspective, they noted that attaching a K-Pro module to a parent KFC store generates a localized 20% sales uplift.
But the most critical insight Joey shared regarding K-Pro wasn't about the calories, it was about the psychology of supply chain trust. She highlighted the immense value of KFC's food safety reputation. In the fresh, light food category, where ingredients are often raw, consumer anxiety regarding supply chain integrity is incredibly high. K-Pro benefits enormously from the fact that KFC has spent nearly 40 years building a bulletproof track record of food safety in China.
That is a massive competitive advantage. You can launch a trendy salad startup tomorrow, but you cannot instantly manufacture the deep psychological trust required to convince millions of people your lettuce is safe.
Exactly. Joey specifically referred to that reputation as a long-term strategic moat that simply cannot be bought with venture capital.
And while K-Pro captures the health-conscious crowd, the main KFC brand is executing relentless menu innovation for volume. They highlighted that their whole chicken category, selling an entire roasted or fried chicken for family at-home consumption, surpassed 2 billion RMB in sales in 2025.
The trajectory of that single product is wild. Introduced in 2021 and sales nearly tripled by 2025. It aligns perfectly with the shift toward delivery and at-home dining. It travels well on a scooter and it feeds everyone.
And to keep the momentum going, they just added new aromatic paper-wrapped roasted chicken. But Joey made a very specific point about how they cook it.
This is where culinary innovation meets operational reality. Joey explicitly noted that the new roasted chicken features a highly simplified cooking process designed to ensure it does not increase complexity for the back-of-house kitchen staff.
That is the absolute essence of fast food operational discipline. A food scientist can invent the most spectacular chicken dish, but if it requires a line cook to spend an extra 3 minutes assembling it, it will completely destroy the drive-thru wait times.
The innovation must serve the operational speed, not the other way around. And we see that same discipline applied to their hyper-localization of the menu. They are continuously introducing regional flavor profiles.
Right. They discussed rolling out Chinese buns stuffed with mala chicken inspired by spicy Sichuan cuisine, alongside offering Wuhan hot dry noodles for breakfast. They are leveraging their supply chain to offer localized comfort foods at massive scale.
So KFC is this unstoppable, multi-pronged juggernaut. Now, let's pivot to the incredibly fascinating turnaround story happening over at Pizza Hut.
The financial transformation at Pizza Hut is remarkable. Operating profit for the brand skyrocketed by a massive 18% in Q1. And crucially, their restaurant-level margin expanded by 60 basis points, reaching 15%.
But the mechanic driving that profit expansion is what makes this a compelling case study. Their ticket average was deliberately engineered downward by 5%.
Deliberately being the operative word. Adrian Ding was unambiguous, stating that this ticket reduction was a core component of their mass market strategy. They're actively driving the average cost per order down toward a target range of 60 to 70 RMB.
Right.
Okay, stop right there. Why would a massive corporation deliberately try to make its food cheaper in an inflationary environment? Dropping the ticket average by 5% sounds like a recipe for destroying your profit margins. Yet their margins actually expanded by 60 basis points. How does the math of making the food cheaper result in making the company more profitable?
CEO Joey Watt summarized the philosophy with a brilliant maxim. Sales first, profit later. Now is later.
I love that quote.
To understand this, look at the brand's positioning a few years ago. Pizza Hut in China was suffering from an identity crisis. Consumers perceived it as slightly too expensive for a casual lunch, but not premium enough for a celebratory dinner. It was trapped in the middle, and foot traffic was deteriorating.
So management executed a radical pricing pivot. They sacrificed short-term profit margins on individual items to fundamentally change the consumer's perception of value. They flooded the market with value campaigns, like reviving their all-you-can-eat promotion.
They explicitly prioritized raw transaction volume over per-ticket profitability, and it worked flawlessly. Same-store transactions at Pizza Hut grew by 5% in Q1, marking a 13th consecutive quarter of transaction growth. They forced the crowds back into the dining rooms.
And here is where the now is later part kicks in. Because they rebuilt that massive volume, they unlocked powerful economies of scale.
Exactly. When you have thousands of people walking through the doors, you can rigorously streamline kitchen operations, centralize prep, and invest in automation. They dropped the retail price by 5%, but their internal cost to produce the meal dropped even faster.
Consequently, their net profit margin expanded. They didn't try to fight consumer caution by stubbornly raising prices. They completely re-engineered their cost structure so they could profitably lower prices.
And to keep those crowds coming back, they are keeping the menu incredibly dynamic. They launched over 30 new dishes for their spring menu. They revamped a third of the entire menu in one season.
And the items signal a shift in identity. They highlighted beef and chicken fajitas and shishuk, poached eggs in a spiced tomato sauce. These are highly visual, interactive dishes.
They specifically marketed these as Instagram-worthy sharing plates. They want young professionals to come in, order a massive spread, take photos, and feel like they got an incredible bargain.
They are methodically transforming Pizza Hut into a vibrant, high-value, casual dining destination.
So we have two distinct, successful brand narratives, which naturally leads to Section 5. Management guidance, and the bottom line. With both brands generating massive cash, what exactly is management planning to do with the treasury?
Let's start with short-term guidance for Q2. They acknowledged that March was a little soft. What caused that specific dip?
Primarily a calendar anomaly. March fell awkwardly into a gap between Chinese New Year and an extra-school spring break that occurred across several provinces in April. Plus, they were facing tough year-over-year comparisons against highly successful campaigns from last March.
But they were quick to point out that April bounced right back. Because of that, management expects a sequential improvement in same-store sales moving through Q2. But what about the profit margins? Can they keep fending off the delivery costs?
For Q2, they expect operating profit margins to remain roughly in line with the prior year. The sheer weight of the rider costs is still a headwind. However, looking further out toward the second half of the year, they provided a very encouraging outlook.
Why would the pressure ease in the fall? The riders aren't going to suddenly accept lower wages.
No, wage rates remain structurally high. The relief comes from the math of year-over-year comparisons. The massive surge in delivery demand really accelerated and locked in during the second half of last year. Therefore, when they compare the second half of this year against the second half of last year, the baseline delivery mix they are measuring against is already elevated.
So the terrifying rate of growth of the delivery cost will flatten out. The shock to the system has already been absorbed. And because that comparison eases, while their rent negotiations and kitchen efficiencies compound, they project a sequential improvement in year-over-year margin comparisons in the second half.
Exactly. The worst of the margin degradation seems to be behind them, which gives management the confidence to reaffirm all of their major full-year financial targets.
Let's explicitly list those targets. They are maintaining guidance for mid to high single-digit growth in system sales. They expect high single-digit growth in operating profit, and they're targeting double-digit growth in earnings per share.
Those are robust targets. But the most staggering revelation wasn't the store counts or the margin targets. It was their capital return strategy. They actively returned $360 million to shareholders in Q1 alone.
That's $214 million in stock repurchases and $102 million in cash dividends.
Yeah.
And they confirmed they are on track to return a total of $1.5 billion to shareholders over the course of 2026.
Adrian Ding pointed out that $1.5 billion represents roughly 9% of the company's entire current market capitalization. That is a massive, immediate yield for investors.
But the real shockwave came when they announced their capital commitment for 2027 and beyond.
Yes. They formally announced that starting in 2027, they intend to return approximately 100% of their annual free cash flow directly back to shareholders.
Right.
They estimate this will average between $900 million to well over $1 billion every single year indefinitely.
Okay, hold on. If they are pumping out $1 billion in free cash flow, committing to give literally all of it back to investors, feels like waving a white flag on future growth.
It does, right.
Yeah. I mean, if you have $1 billion sitting in the bank, shouldn't you aggressively plow that money back into the business, build more stores, develop new brands? Isn't giving 100% of the cash away a signal to the market that management is completely out of ideas and has given up on expansion?
It is completely logical to view it that way. But when you place this commitment in the specific context of Yum China's current operational structure, it is not a white flag. It is the ultimate flex of corporate maturity. It is an incredibly bullish signal regarding their capital discipline.
Walk me through the mechanics of why giving the money away is a flex.
To understand this, look back at the structural shifts we analyzed: modular warfare and franchising. Yum China has optimized its capital expenditure pipeline to a degree that is almost peerless. By leveraging the capital of local franchisees to build out new territories, and by radically shrinking the construction costs of their corporate W&W and Gemini stores, they have fundamentally decoupled their growth rate from their own cash burn.
The light bulb just clicked. It's not that they're starving the company of capital. It's that the growth engine has become so insanely capital efficient that it barely needs corporate fuel to run.
Exactly.
They can fully fund the aggressive march to 20,000 stores, invest in supply chain automation, build out the BYD dashboard integrations, and still have over $1 billion in pure profit left sitting on the table at the end of the year.
It is the definition of a hyper-optimized cash cow. And here is why Wall Street loves the 100% return commitment. Historically, when a massive corporation finds itself generating $1 billion more than it needs, executives tend to do foolish things.
Empire building.
Exactly. They get bored. They attempt to acquire a struggling, unrelated brand just to show top-line revenue growth. They launch incredibly expensive, doomed expansions into foreign markets they don't understand. They destroy shareholder value.
But by publicly committing to return 100% of that free cash flow via dividends and buybacks, Joey Watt and Adrian Ding are locking the executive team into an ironclad financial discipline.
They are explicitly telling the market, we will only invest your money in high-return, highly proven domestic restaurant projects. We won't waste the excess. Every dollar we can't deploy at a massive return belongs to you.
It is a remarkable place for a corporate entity to reside. It's a self-funded, hyper-efficient machine that delivers high-yield growth while aggressively shrinking its own outstanding share count.
Spot on.
You know, this whole deep dive really paints a completely different picture of the fast food industry than the one most people hold. We set out to decode the Q1 2026 earnings call, and the narrative that emerged is just an absolute masterclass in operational agility under severe pressure.
It really is. Yum China is operating in a landscape where consumers are guarding every penny and where the demand for home delivery has fundamentally broken the traditional restaurant cost structure.
And rather than fighting those macro shifts, management has restructured the very DNA of the company to thrive within them. They are rapidly shrinking their physical real estate footprints, deploying modular stores that require less capital, and actively leveraging franchise investment to expand at record speed.
They are ruthlessly using their massive scale to force commercial landlords into cheaper rent agreements, perfectly offsetting that brutal 30% labor cost of employing a literal army of delivery riders.
And over at Pizza Hut, they executed a flawless mass market pivot using high volume, lower price food to drive incredible back of house efficiencies, ultimately expanding their profit margins. It is a company that has figured out how to exert absolute control over every single variable they can touch.
And as we close out this analysis, I want to leave you with one final speculative thought that builds directly on the operational realities we've unpacked today, but looks just a bit further over the technological horizon.
Oh, I like where this is going.
We spent a significant amount of time detailing the delivery dilemma. We know that human rider costs represent a staggering 30% of their total cost of labor. And we know that even as platform subsidies rationalize, the pure human cost of navigating a scooter through a city is a permanent weight on the P&L.
Right. Management mitigated it masterfully through real estate leverage for now.
Yeah.
But there is a hard physical limit to how much you can optimize human delivery.
Exactly. You can only make a human being on a scooter move so fast before physics and safety intervene. The human element is the ultimate bottleneck. So what happens when they hit the absolute ceiling of human optimization?
That is the big question.
Look at the sheer scale and the technological integration of Yum China. They are rapidly approaching 20,000 physical nodes across the country. They already process millions of highly localized digital transactions every single day. They are actively integrating ordering systems into the dashboards of BYD electric vehicles.
They possess the density, the cash flow, and the digital infrastructure.
So the question becomes, how long until an operation this massive, this well-capitalized, and this ruthlessly focused on margin efficiency begins replacing the human delivery fleet entirely with autonomous delivery drones or self-driving, temperature-controlled delivery vehicles?
Wow. If they could completely eliminate that 30% human labor cost from the P&L and replace it with a fixed, predictable depreciation cost of an automated machine fleet, the margin expansion would be astronomical.
When autonomous last-mile delivery technology becomes economically viable at scale, Yum China is uniquely positioned to deploy it faster and more efficiently than almost any other entity on the planet. And when they flip that switch, they will fundamentally rewrite the economics of the restaurant industry all over again.
It is not a matter of if the delivery fleet becomes automated. It is simply a matter of when.
Exactly.
When you spend decades learning how to perfectly rebuild the engine while the 18-wheeler is hurtling down the highway, eventually you figure out how to make the truck drive itself.
That's beautifully said.
It is a massive, incredibly complex operational story and a fascinating thought to leave you with. Thank you for joining us on this deep dive into Yum China's strategic machinery. We hope we've successfully translated the earnings call data into insights you can actively use to understand the massive forces shaping the market and your portfolio. Keep challenging the numbers, keep looking for the mechanisms behind the headlines, and we will catch you on the next deep dive.